Hello again, option traders. It's Mike from 10 Delta Trading with my second ever YouTube video. I forgot to say that in my first one, that it was my first, so now you know. Please forgive the amateurish quality, but I hope to get better. Today I want to talk about a mini revelation I had about one of the option Greeks, gamma. And if that word doesn't strike fear into your heart, then you haven't been around options long and or haven't gotten advice on why you shouldn't trade short-term options, because gamma risk will kill you. I wish I could make my voice sound all spooky right there. Anyway, on with the program. Gamma and gamma risk. So what is gamma? It's one of the option Greeks, which are those 5 symbols right there. I won't even go over them. The conventional wisdom is that you must know the Greeks to be a successful options trader. But I wonder if that's really true. So these are possibly famous last words. You might want to take a screenshot of this. Quote, "But I don't know the Greeks, except maybe Delta, and that's arguable. And I've done all right with short strangles." Who said that? Me, Mike at 10 Delta Trading. So let's move on. Here are some places to read about the Greeks in particular, gamma, and the boogeyman gamma risk. You've got Investopedia, Project Option, Options Trading IQ, and Tasty Trade. All of those are great resources that I've learned a lot from. I'll put those links down in the description. So more conventional wisdom. Tasty Trade and many others, likely influenced by Tasty Trade, say to put on options trades 30 to 45 days out. 30 to 45 DTE, or you'll see it called, days to expiration. That's sound advice and it works. But a lot of things work when using options, until they don't, as people are fond of reminding you. I started trading that way, the Tasty way, and then gradually pulled back to 3 weeks, 2 weeks, then finally 1 week with these short strangles that I'm doing. It just seems to me that with less time for things to go wrong, less things go wrong. But whenever I'd say that to someone on a Reddit forum or somewhere, I'd invariably get told, "You shouldn't do that because gamma will eat your lunch." Well, gamma has nibbled at my lunch, and until I figured out what was going on, I'll admit that it did scare me a bit. But something clicked with me today that I want to share with you. So this is a curve of gamma versus time. The graph is centered on an at-the-money call or put, it's the same, at the 25 strike. The blue curve, the lower one, is 30 days out. The red is 15 and the gray is 5 days away, 5 days to expiration. The takeaway, I think, is that gamma gets higher the closer you get to expiration. And gamma is a multiplier in the equation for the value of a stock's options, just like delta is. So it's going to raise the prices of options the closer they get to expiration. So I was scrolling through my active trades today, making sure things were behaving. So here's what I look at. This is a trade that I put on last Friday. It's on fuel cells, a short strangle. I put it on Monday morning for a credit of 11 cents. It's now after the close on Tuesday, and we see that the options are trading here at 3.5 cents each. And this was the 11-cent credit that I got, 6 plus 5. So right now this trade is trading for 7 cents. So this trade has already made 4 cents, 11 minus 7, which in option terms is $4 per contract. And I have 60 of these contracts on. So 4 times 60 is $240. But look at the stock price on this. Oops. The stock price is $8.40. $8.42. The strikes are at 7 and 10.50 right here. So $8.40 is nicely between them. And as time goes by, the options steadily lose value because there's less time until expiration. So there's less demand for an option that's $1.50 to $2.50 out of the money with only 3 days to go. So I have a 3-cent buy to close order on this, which is another 4 cents down from here, 7 cents. So if the stock keeps behaving, I'll earn another $4 per contract for a total of $8 over this whole trade. Times 60 contracts is $480. The buying power effect, or BPE, on this trade would have been about 5% of the account value, because that's the size of each trade you want to use. So about $5,000, giving this trade a rate of return of almost 10%. That's 2% per trading day if it doesn't close until Friday. Even more per day if it closes earlier, which is likely. That's nice, right? I could show you a bunch of trades that have done just this. Let's look at another one. I put this trade on Gamestop Friday afternoon, and you're saying, not Gamestop, but Gamestop has been very good to me with short strangles. So let's look at this. The strikes are really, really wide at 147 and 240. And that's the beauty of 10 Delta. And the stock's price is 215. Still nicely between these ditches. But look at the price of the 240 call option. Right now the mark, the price of that option is 627. It's sold, and I sold it for only $1.58. So even though the spot price right here is $25 away from this call option strike, the price of that option has quadruple. Now I think that's gamma risk. So I looked at GameStop's chart, and it went up 16% today. And note here too where the 147 and 240 strikes would have been in relation to this 1 week price action. So if I put this on Friday, this is Tuesday, Monday, Friday, back here, 140 is way down here, 147. 240 is up here. So, and the delta on this leg went up from about 10 when I sold it back here to now 29. This is the option chain after hours today. And that has an effect on the options price, but I suspect that it was gamma that had the larger effect. I don't know for sure, so someone comment in the comments if I'm way off base. But you know what? Do I really care that the trade is upside down right now due to reasons? Maybe gamma. What I really care about is that the stock's price stays between the strikes by expiration. If it does that and all the time is run out, then the options have to expire worthless and I keep the credit received. Credit was $2.56, so I have a 75% profit taking buy to close order at 64 cents. But I'll be watching this one closely to make sure it does stay between the guardrails. And that's it for this video. I wanted to share how I monitor trades, and I'll be doing some videos on how to adjust trades, but I really wanted to just share this thing I noticed today with the inflated option price on GameStop and how I think that's the effect on gamma, effect of gamma. So don't let this options price scare you right now. We've still got 3 days to go. And as long as the stock price stays between these strikes, it'll be okay. There's one more thought related to this. When you've bought a stock and its price tanks, people always say it's not a loss until you sell it, right? Well, this is Bill O'Neill, founder of Investors Business Daily. I love IBD. Here's what he says about paper losses. Paper loss is a real loss. And if you think you haven't incurred a loss until you sell the stock, you're kidding yourself. Right? And I'm in vehement agreement with that. It is a loss. Your account is worth less than it was yesterday. If you had to close it out today for dollar bills, they're going to give you less of them today than they would have yesterday. That's a loss by any measure. But what about this GME short strangle that's also a loss on paper? Is it a real loss or a paper loss? I submit that it's a paper loss. It's not a real loss. Do these 3 call options that someone holds, these contracts that say he or she has the right to buy GameStop at 240, do those have any real value at this moment in time when GameStop is trading at 215? No, they don't. Sure, those contract holders could exercise on me, but I'd gladly sell them 300 GameStop at 240, which I could have bought in the market at 215 right before selling to them. I'd make $25 per share, or $2,500 per contract on that deal, times 3. So no, those options have no value because no reasonable person would make that trade. In option speak, these options have zero intrinsic value. They have no real value because owning them wouldn't make you any money. But what they do have is what they call extrinsic value. Extrinsic value. They only have perceived value because people think that GameStop might go to 240 in the next 3 days. Not only that, but they're offering to pay $6 per stock, $600 for 100 stocks that they'll be controlling, for the option to buy GameStop at 240. So they really need GameStop to be greater than 246 in order to profit. Will GameStop break 246 in the next 3 days? Maybe. It is GameStop after all. But when I put this trade on, the 10 delta of that 240 call said it had only a 10% chance of being exceeded by expiration. So we'll wait and see. And if GME does break 240 or even really threatens it, I'll post a video of how to manage the trade so we don't lose any or much or too much money. Meanwhile, I'm tracking all my trades on my little blog, 10deltatrading.com, for you all to keep me honest. It doesn't look like much right now, and WordPress is kicking my behind, so please, if anybody knows how to work WordPress, reach out to me and help me make the site more useful. But only if you've been getting anything out of these videos, which I hope you have. I'm not selling anything, just trying to spread the word about this 10 delta short strangle strategy. Thanks for watching.